Yesterday, a routine regulatory filing landed on the desks of Wall Street analysts that fundamentally challenges the prevailing political narrative of a one-sided trade war. While the White House continues to threaten the complete dissolution of North American trade frameworks, the Bank of Montreal quietly finalized the architecture for a major expansion on American soil, committing to open more than 130 new retail branches across California and an additional 15 in Arizona over the next 5 years. This specific deployment of capital occurs not during a period of economic tranquility, but in the exact window where the United States has escalated tariffs on Canadian goods to 35%, revealing a profound disconnect between political rhetoric and structural financial integration. To understand why this systemic pivot matters, one must look at the timeline of the broader North American trade dispute. Since February 2025, the bilateral relationship has faced its most severe disruption in a generation, initiated by a 25% American tariff on Canadian manufacturing and a 10% levy on energy imports. Ottawa countered by targeting $30 billion of American products, a retaliation that subsequently scaled to encompass $155 billion in trade value. Yet, while administrative officials publicly declare that the economic leverage remains entirely asymmetric in Washington's favor, Canada's largest financial institutions are executing a multi-billion-dollar entry into the domestic American market, fundamentally embedding themselves into the daily financial life of millions of American citizens. That sequence is not coincidental. It is a direct policy statement. The foundational pillar of this current expansion occurred in February 2023, when the Bank of Montreal completed its $16.3 billion acquisition of Bank of the West from French conglomerate BNP Paribas. That transaction instantly transferred 1.8 million American customers and over 500 physical branches across 32 states into a Canadian corporate ecosystem, rendering the combined entity the 8th largest bank in North America by total assets. For decades, the institution had anchored its American operations via the Harris brand within the steady, moderate growth corridor of the American Midwest. By absorbing Bank of the West, the bank acquired immediate, scaled access to California, a jurisdiction with a population of 39 million people and an independent gross domestic product that surpasses most sovereign nations. What that acquisition demonstrates structurally is that Canadian capital is no longer content acting as a peripheral participant, opting instead to secure direct exposure to the most lucrative consumer markets on the continent. This entry into the Pacific Coast was immediately followed by a calculated reallocation of capital away from low-growth regions. In October 2025, the bank announced a strategic overhaul of its traditional American footprint, selling 138 branches across the Great Plains and Midwest, including networks in North Dakota, South Dakota, Wyoming, Nebraska, and Kansas, to First Citizens Bank. That transaction transferred approximately $5.7 billion in assumed deposits and $1.1 billion in purchased loans out of stagnating rural demographics. The objective was explicitly clarified in March 2026. When corporate leadership announced that the capital retrieved from those agricultural markets would be immediately deployed to fund the 130-branch expansion across the high-density metropolitan corridors of Los Angeles, San Diego, and the San Francisco Bay Area. Inside executive suites, this playbook is known as densification, a retail strategy predicated on saturating high-velocity wealth hubs until the corporate brand becomes statistically unavoidable for local small businesses and retail depositors. This pivot away from rural geography toward coastal wealth concentrations indicates that the institution expects the primary drivers of future North American banking revenue to generate from highly concentrated American urban centers rather than dome-stick Canadian expansion. However, the Bank of Montreal is not operating in a vacuum. Its aggressive timeline was heavily accelerated by a severe regulatory crisis engulfing its primary domestic competitor. In October 2024, the Toronto-Dominion Bank was hit with a historic $3.1 billion penalty by the United States Department of Justice and the Office of the Comptroller of the Currency, following an investigation into systemic failures that allowed illicit syndicates to route hundreds of millions of dollars through American branches. Crucially, regulators imposed a strict asset cap on TD's two primary U.S. subsidiaries, freezing their combined balance sheets at $434 billion and forcing the institution to halt its own planned 150-branch expansion across the American Southeast. While TD was forced to shrink its U.S. presence, liquidate securities, and divert billions into compliance restructuring, its Montreal-based rival deliberately weaponized the timing to launch its California offensive. This dynamic reveals how aggressively Canadian institutions compete against one another for American market share, proving that the drive southward is dictated by institutional rivalry and market logic rather than a synchronized national strategy. Simultaneously, other major Canadian entities have established completely distinct pathways into the core of the American financial system. The Royal Bank of Canada utilized a wealth management blueprint when it acquired Los Angeles-based City National Bank in 2015, an institution managing approximately $96 billion in assets and heavily integrated into the entertainment and high-net-worth sectors. By the close of the last fiscal year, RBC's U.S. Wealth Management Division reported a 12% revenue increase, generating $8.9 billion Canadian dollars, and prompting leadership to publicly state they possess the capital reserves necessary to theoretically target acquisitions on the scale of major American brokerages. When combined with the steady expansion of the Canadian Imperial Bank of Commerce across the Midwest and Florida through CIBC Bank USA, the aggregate data shows that 4 of Canada's 6 largest banking institutions now command thousands of physical branches on American soil. This extensive network means that the financial infrastructure supporting millions of American mortgages, commercial small business loans, and retirement accounts is tethered to corporate headquarters in Toronto and Montreal. The presence of these multi-billion-dollar balance sheets creates a stark paradox when contrasted with the political positioning observed in Washington. Throughout the tariff escalations of 2025, the public discourse focused almost exclusively on border restrictions, supply chain decoupling, and zero-sum trade balances. Yet, the continuous flow of banking capital demonstrates that while a state can impose tariffs on physical steel or agricultural commodities, it faces immense structural hurdles when attempting to decouple from deeply embedded financial service providers. The American retail banking sector has become highly reliant on these foreign capitalized institutions to maintain liquidity and credit availability in major regional economies. Consequently, any political effort to aggressively penalize Canadian corporate interests inadvertently risks disrupting the credit access of the very American consumers and small businesses the administration claims to protect. The real test of this institutional leverage arrives in July 2026, the mandatory date for the joint review of the United States-Mexico-Canada Agreement. This specific provision requires all 3 nations to formally confirm whether the trade architecture will be extended for another 16-year term or allowed to enter a trajectory toward expiration. Because financial services, cross-border investment guarantees, and regulatory equivalence frameworks are deeply woven into the text of the USMCA, an outright lapse of the treaty would significantly complicate the legal environment for cross-border banking operations. But the strategic configuration of the current branch networks suggests that Canadian executives have calculated that the cost of compliance under a fractured trade regime is heavily outweighed by the sheer scale of American deposit revenues. The broader question, the one that central bankers and trade negotiators are monitoring with intense strategic scrutiny, is whether the sheer volume of American deposits held by these institutions now grants Ottawa an unacknowledged, non-military defensive shield against further economic coercion. The unfolding corporate expansion on the Pacific Coast directly undercuts the conventional geopolitical wisdom that trade restrictions can isolate a secondary state. While sovereign leaders weaponize border enforcement and point-to-point tariffs, the continuous flow of capital via retail financial channels establishes an economic interdependence that operates entirely outside the jurisdiction of traditional trade enforcement mechanisms. by shifting the perspective away from the public messaging of administrative officials and onto the concrete asset distributions of major commercial entities. A highly synchronized counter-cyclical strategy emerges. This strategic architecture is not designed to bypass political confrontation, but to neutralize it by embedding external financial institutions directly into the core engine of domestic American consumer credit. The foundational evidence for this deliberate economic positioning resides within the explicit communications directive at global financial markets rather than domestic political audiences. During the comprehensive all-bank Investor Day convened on March 26, 2026, Chief Executive Officer Darrell White addressed the global investment community to articulate the long-term rationale for the ongoing reallocation of corporate assets. What that presentation reveals is a calculated assessment that the institutional upside of securing long-term wealth market share within the world's most robust consumer economy heavily outweighs the transitory headwinds imposed by bilateral border restrictions. Instead of signaling a tactical retreat or an administrative pause in response to the parallel 35% tariff landscape, executive leadership explicitly codified a binding medium-term objective to elevate their total return on equity past 15%. This specific operational target establishes that Canadian banking strategy is no longer tethered to domestic economic cycles, utilizing the higher interest margin environment of the broader American market to insulate its aggregate balance sheet from localized trade shocks. This internal corporate prioritization of cross-border expansion is further authenticated by the said geographic trajectory of recent retail banking assets. Corporate financial data disclosed during the same March 2026 symposium indicated that the Bank of Montreal's personal and commercial deposit penetration within the state of California rested at approximately 2%, precisely half of the historical market share the institution commands throughout its mature Midwestern footprint. That structural disparity is the primary catalyst driving the immediate, capital-intensive deployment of 130 new physical branches across the high-density metropolitan areas of Los Angeles, San Diego, and the San Francisco Bay Area. By focusing capital exclusively on urban zones where brand awareness has effectively tripled inside a 24-month window, corporate planners are intentionally bypassing traditional, slow-growth agricultural and industrial zones that are highly sensitive to trade retaliations. What this specific density initiative indicates is a structural determination to transform a regional 2% market foothold into a dominant retail position, directly capturing the massive liquid cash reserves generated by the highest-grossing subnational economy on the continent. To achieve this level of physical saturation during an era of broader macroeconomic uncertainty, corporate leadership executed an aggressive structural reorganization of its entire American executive command chain. In the final half of 2025, the bank consolidated its independent United States personal banking, business banking, commercial banking, and wealth management divisions into a singular, unified operating model under the direct oversight of Group Head Ernie Ciarino. That management convergence was specifically engineered to accelerate cross-selling capabilities, allowing individual retail branches to seamlessly route consumer depositors into high-margin wealth management pipelines and industrial treasury services. That administrative consolidation demonstrates that the institution is no longer treating its foreign acquisitions as passive isolated asset holdings. This structural integration instead operates as a streamlined mechanism designed to rapidly extract capital from the American Pacific Coast and redirect it into the global corporate balance sheet, ensuring that every newly established physical branch serves as an active engine for institutional revenue generation. The financial validation of this cross-border capital reallocation manifested clearly during the subsequent public reporting period. On May 28, 2026, the institution released its official second quarter financial results to global markets, recording an adjusted net income of 2.73 billion Canadian dollars, an absolute 34% surge compared to the 2.04 billion Canadian dollars reported during the identical operational period 1 year prior. That significant earnings expansion was heavily reinforced by an adjusted return on equity that advanced to 13.5%, accompanied by a robust 10% expansion in total revenues on a constant currency basis. These specific metrics confirm that the underlying profitability of the institution is scaling rapidly even as bilateral trade rhetoric reaches its most confrontational point in decades. This continuous financial outperformance effectively signals to global credit markets that the financial integration of North America has achieved an operational velocity that is entirely decoupled from the explicit policy directives of trade. Negotiators in Washington. Canada Newswire. The strategic imperviousness of this banking expansion is further illuminated by the precise legal mechanisms governing international trade disputes. Under standard international law, the imposition of border tariffs is strictly confined to the movement of physical goods, agricultural commodities, and material industrial inputs, leaving the sovereign movement of liquid corporate capital and institutional equity acquisitions entirely unencumbered. This critical regulatory distinction explains why the escalation to a 35% tariff on physical Canadian manufacturing failed to slow the progression of the Bank of Montreal's California branch rollouts or freeze the Royal Bank of Canada's expansion of City National Bank out of Los Angeles. While the White House possessed the statutory authority to heavily disrupt physical border infrastructure, it possesses no parallel legal framework to summarily seize or dismantle the legally compliant domestic subsidiaries of G7 financial institutions. This asymmetry means that the cross-border banking sector has successfully weaponized the structural limitations of trade law, establishing a multi-hundred-billion-dollar presence that remains functionally insulated from the direct application of executive economic penalties. The real test of this asymmetric integration now centers on a specific, non-negotiable diplomatic deadline. In accordance with the formal review mechanisms embedded within the United States-Mexico-Canada Agreement, all three sovereign signatories must formally convene in July 2026 to execute a joint comprehensive audit of the trilateral trade framework. That mandatory review requires each participating government to explicitly state whether they will formally reaffirm the existing economic treaty for an additional 16-year term, or allow the architecture to enter an automatic sunset trajectory toward complete expiration. Because the foundational legal protections for cross-border banking operations, regulatory equivalence, and reciprocal investment security are legally bound to the survival of the USMCA. The upcoming July summit stands as the definitive event that will determine the final parameters of North American financial integration. The critical question, the one that global central banks and international credit markets are monitoring with extreme strategic calculation, is whether the deep structural reliance of major American metropolitan economies on Canadian financial capital will ultimately force a political retreat from the rhetoric of complete economic decoupling. The strategic trajectory established across the preceding operational periods underscores an economy that has fundamentally outgrown the regulatory boundaries of 20th century diplomacy. While public administrators remain fixated on the visible mechanisms of industrial tariffs and border enforcement, the real alignment of regional power has shifted decisively into the realm of integrated commercial balance sheets. This convergence of retail banking operations, systemic credit provisioning, and liquid deposit collection has created an infrastructure so deeply embedded within the domestic fabric of the United States that it defies conventional political manipulation. By analyzing the long-term motivations of the key actors on this expanded board, the broader structural pattern becomes clear, transforming a localized trade dispute into a case study of modern economic leverage for the United States. This deep financial integration represents an unacknowledged domestic vulnerability, masked as a standard regulatory oversight. The expansion of institutions like the Bank of Montreal into the affluent corridors of California and Arizona means that a significant portion of domestic consumer liquidity and small business credit is now managed by entities answering to external, corporate boards. Washington's traditional economic strategy has long relied on the absolute dominance of its internal market to compel concessions from secondary trading partners. However, when those exact partners control the retail banking hubs, agricultural lines, and urban wealth management systems inside the largest states of the Union, the traditional leverage points begin to fracture. The immediate consequence is a severe restriction on the administrative ability to execute complete economic decoupling without triggering a localized credit squeeze or destabilizing regional financial services for millions of its own citizens. For nada. The aggressive push into the American retail banking grid operates as a calculated sovereign defense mechanism disguised as corporate expansion. Faced with an unpredictable trade landscape and recurring infrastructure penalties from its southern neighbor, Ottawa has effectively allowed its primary banking sector to construct a multi-hundred-billion-dollar economic shield. By anchoring their corporate growth to the most dynamic consumer hubs on the planet, Canadian financial institutions ensure that their institutional viability remains detached from localized border restrictions on manufacturing or energy. This integration creates a complex web of mutual economic dependency, establishing a baseline where any sudden regulatory disruption aimed at Canadian corporate interests carries an immediate symmetrical cost for American communities. Consequently, the expansion provides the northern state with a durable form of structural deterrence, neutralizing raw political coercion through the quiet accumulation of domestic market share. This paradigm shift also offers highly specific strategic insights for secondary global observers monitoring the evolution of North American economic space. European banking conglomerates, which largely spent the last decade divesting from complex retail networks within the United States to satisfy domestic regulatory constraints, are now witnessing the rapid filling of that structural vacuum by highly concentrated regional alternatives. Simultaneously, emerging economic powers like India, increasingly focused on securing direct investments and bilateral trade security within Western markets, are observing a novel blueprint for economic resilience. The overarching lesson for these external actors is that true geopolitical resilience in the current century is achieved not by contesting the dominance of the American consumer engine from the outside, but by systematically acquiring the financial pipelines that keep that engine running from within. The absolute baseline of this entire development is that modern economic warfare has evolved beyond the crude application of state-level border sanction. The continuous growth of Canadian retail infrastructure directly inside major American wealth centers proves that integrated corporate capital possesses an operational velocity that completely bypasses state-sponsored trade disputes. While administrative officials continue to utilize the language of borders and walls to project authority to domestic audiences, the international banking sector has quietly established a parallel network of financial bridges that cannot be dismantled without inflicting severe self-inflicted damage on the domestic economy. Ultimately, the balance of economic power between these two historical partners is no longer dictated by the visible volume of goods crossing the frontier, but by the invisible cross-border ownership of the deposits that fund the daily life of the continent. The real leverage belongs